All right, let's get right into it. If you're starting a business in the UK, there is one decision you have to make right at the very beginning that honestly changes everything. We're talking about your tax, your personal risk, and your future. We're going to break down that single choice, sole trader versus a limited company.
So, yeah, that's the big question. What's your business structure going to be? Are you going to be a sole trader or a limited company? Now, I know it sounds like boring paperwork, but trust me, this single decision has a huge ripple effect on your taxes, your personal risk, and even how big clients see you.
The easiest way to think about this is like choosing between two completely different paths. On one side, you've got the simple route, that's the sole trader. And on the other, you've got the protected route, the limited company. So let's walk down each path and see exactly what that means for you, starting with the simple one. Okay, so path number one, the sole trader. The name of the game here is keeping things as straightforward and as flexible as humanly possible. So what does being a sole trader actually mean? Well, it's beautifully simple. You are the business. There is zero legal separation. You and the company are one and the same. And that means every single pound of profit your business makes is just treated as your personal income by HMRC. Now, the biggest appeal here is just how easy it all is. The admin is an absolute breeze. You're just doing a single self-assessment tax return every year. Your accountant will love you, and the fees can be way, way cheaper. Plus, because you're not on a public register, how much you earn is your own business. It's designed to be a really low-stress way to get started. But, and it is a pretty big but, that simplicity comes with some really serious trade-offs. Every penny of profit gets hit with both income tax and national insurance, which leaves you with very few clever ways to plan your tax. But honestly, the most important one, the one we really need to talk about, is unlimited personal liability. This right here is what unlimited liability means in the real world. Because you and the business are legally the same person, if the business gets into debt or, worse, gets sued, your personal assets are on the line. We're talking your home, your car, your personal savings. It's all fair game. This is the single biggest risk of going down the sole trader path. So who is this path really for? Well, it's pretty much perfect if your profits are likely to stay under about £30,000 a year, if your income jumps up and down, or if your number one priority is just keeping the paperwork to an absolute minimum. Now, let's switch over to path number two. This is the limited company. And this route is all about two things: financial optimization and, most importantly, protection.
A limited company is a complete game changer because it's a totally separate legal entity from you. It's kind of like you've created a new person in the eyes of the law. The company earns the money, it pays its own taxes, and then you, as the director, get to decide how to pay yourself out of those profits, usually with a smart mix of a small salary and dividends.
And this legal separation is incredibly powerful. First, you get that limited liability, which means your personal assets are safe and sound. Second, it gets way more tax efficient as your profits start to climb. A lot of bigger corporate clients also see that LTD after your name and see it as a sign of being a serious professional operation. And you get some really clever financial options, like making pension contributions directly from the company before tax is paid. Of course, there's no free lunch. All this protection and tax savviness comes with a trade-off: more complexity. You've got more paperwork, like filing annual accounts and a corporation tax return. Your accountant's bill will definitely be higher, and your company's basic financial information is published on Companies House for absolutely anyone to look up. So, this path is really designed for people who are consistently earning over £40,000, anyone who absolutely needs that shield of liability protection, or entrepreneurs who have really clear long-term plans for growth.
Okay, so we've looked at the two different philosophies. Now for the main event, the head-to-head showdown. This is where we see exactly how the numbers stack up and when money really does change everything.
This table right here, this is the rule of thumb you need to remember. If you're earning under 30 grand, the extra admin costs of a limited company usually mean it's not worth it. Sole trader is the clear winner. But as soon as you start creeping past that £40,000 mark, well, the financial scales start to tip pretty decisively. Let's just call this the magic number. Around £40,000 in annual profit. That is the financial tipping point where setting up a limited company almost always becomes the smarter move financially. And the reason why? It's all about how you get taxed. So, as a sole trader, your profits get hit with a double whammy: income tax and those hefty national insurance contributions. But with a limited company, it's a two-step process. The business pays corporation tax on its profits first, then you pay dividend tax on the money you take out. Now here's the secret. Dividends are not subject to national insurance, and that right there is where the big savings really start to kick in. Let's make this really concrete. Say your business makes a profit of £60,000. Look at the difference. Someone running a limited company typically takes home somewhere between £600 and £1,000 more per year than a sole trader making the exact same profit. And as those profits go up, that gap just gets wider and wider. So we've covered the paths, the pros and cons, and the cold hard numbers. Let's bring this all home and give you a final verdict to help you make your own choice. Here's a super simple checklist to walk you through it. First, be honest with yourself about your profit. Is it going to be consistently over that £40,000 tipping point? Second, what's your risk level? Are you signing big contracts where things could go south? Third, think about your clients. Are you dealing with big corporates that kind of expect to see LTD after your name? And finally, how serious are you about planning for your pension? Or, look, if you want to put even more simply, here it is. Go sole trader if your profits are on the lower side, you value simplicity above everything else, and your business has very little risk. Go limited if you're earning more, you absolutely want to protect your personal assets, and you're aiming to work with those bigger corporate clients. And just like that, we're right back where we started, looking at our two paths. The choice really is yours. The sole trader route is all about simplicity and flexibility. The limited company route is all about optimization and protection. Neither one is better. The only thing that matters is which one is better for you, right here, right now. So I'm going to leave you with one last question to think about, and it's not really about tax at all. It's about ambition. Are you building a flexible business that works for you today, or are you laying the foundations for an enterprise you want to build for tomorrow? Your answer to that question will probably tell you everything you need to know.